From the morning reading, the S&P snapshot, the sell-off moderates in day 4. The S&P 500 logged its fourth consecutive daily loss, but today's negative 0.18% close was well off the negative 0.72% intraday low at the beginning of the final hour of trading. Financials were the biggest drag on the index. The XLF Financial Sector ETF ended the session with a 1.48% loss. The market continues to send a message to the FOMC prior to its 2 p.m. Eastern statement, followed by Chair Yellen's press conference. The 10-year note closed at 1.62%, unchanged from the previous session. The 20-year bond yield dropped a single basis point to 2% and a new post-recession low. The 30-year bond remained unchanged at 2.43%, which is only 18 basis points above its post-recession low. The SPY sell-off slows as a doji candle forms in anticipation of the FOMC announcement this afternoon. 5 of 9 sectors moved higher on Tuesday. XLU, XLP, and XLK were the strongest sectors, while XLF was the weakest sector. Oil futures fell 66 cents to close at 47.90. Breadth weakened as decliners led 1968 to 1047 on the New York Stock Exchange and 1542 to 1061 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 6:57 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 15th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. We're a bit late this morning. We've had problems with our recording and some of our data feeds, and bottom line is everything's a little late, so we're going to do an abbreviated version of this, but I did want to go ahead and get this out. In terms of the morning report, we have all 4 U.S. broad market indices are just slightly up at the time of this cut. Crude oil, though, was down pretty sharply, down over 1%. Euros up just above scratch. Bonds just below scratch, and gold down about 0.4%. Overseas action is all positive on the 5 markets that we follow. China up 1.6%, Hong Kong 0.4%, as is Japan. Germany up about 1%, United Kingdom up just below 1%. A full slate of macroeconomic reports from the United States today of note, including PPI, core PPI, industrial production, capacity utilization. You have crude oil inventories with their weekly report, and then the cluster with the FOMC economic projections, the statement, the Fed funds rate, followed all that by a press conference by Chair Yellen. So you'll have an enormous amount of influences on the direction of the market coming in with these various reports, especially the FOMC today. Likely after the first hour of trading or so, we'll see the market start to kind of go sideways. Very calm, very low volume, not a lot of follow-through on any kind of signals and setups until we get through the FOMC announcement. So for most investors and traders, there'll be a lot of sitting on hands this morning. In terms of current volatility conditions, our short-term VIX up to a 23 skew, very elevated, up over 135. So that puts us at about 14% probability of a 2 standard deviation move in the next 30 trading sessions. IV percentiles have been climbing of late, with the S&P currently we're at 32, the Russell 34, NASDAQ 25, and Dow at a 27. No standard deviation moves were put on a close-to-close basis yesterday, and indeed, as you heard from one of the morning author reading quotes, we ended up with basically dojis across the various charts. We'll go ahead and take a look at those charts. Frankly, not an awful lot to get excited about, and from new information on the charts, we basically ended up with dojis yesterday. Remember, this green candle is last night's action. This is your candle from yesterday. And you pretty much see the same news on each of them. one of the things to point out, we talked about this sweet spot yesterday with the fib clusters and many traders using that area between the 50% and the 618 as a potential reversal area, looking for to accumulate some position to take that in the opposite direction. And indeed, price action moved just to the 618 retracement, then bounced, and then closed right at the 50% retracement. So pretty predictable setup there yesterday. Now, where it goes from here is going to be very much influenced by these macroeconomic reports of today, including the big FOMC cluster of announcements. In terms of the other indices, we're going to just quickly fly through these. There wasn't any new information. They've been very highly correlated one to another of late. You see the Dow. The NASDAQ actually pulled a slightly positive day, but still essentially a doji. The Russell, also a doji pattern with yesterday's candle. Bonds, of course, continue to have this significant breakout. And while there was an intraday reversal yesterday, and much in parallel with the equity markets, you see a higher close with the bonds. You take a look at TLT. You know, yesterday was indeed a new 52-week high. And then gold, the other safe haven in some occasions, also continued yesterday with its march upward, though notice that these candles are starting to get smaller and the bodies are smaller, and we're starting to seemingly run out of some steam. Many of these markets are indeed running out of steam and coming into consolidation and in anticipation of the FOMC, and people are starting to wind down their swing trades and then go flat and then wait for that announcement before initiating new positions. So that's part of this as well. So it's not just what's happened in the last 2 weeks, but it's also in the anticipation of the FOMC. So let's go ahead and go to the daily report. And we continue to see some short-term deteriorations. Of course, we talked about yesterday the intermediate-term phase opinion going to phase 5 on that aspect. That was called the in short-term, the break of diagonal and horizontal support. You have with the 3 market timing signals, the IBD, deteriorated to uptrend under pressure. That happened a couple sessions ago now. GMI index still has not been updated. That blog author is away, so we're not sure where the GMI index is at this point. But the third mechanical signal that comes to us from Stock Chart's Decision Point Scoreboard, notice that we had a flurry of new signals on the short term, and they're all negative in terms of deterioration. We had 1, 2, 3, 4 new bearish signals and 2 new neutral signals coming in across these various indices. So quite a bit of deterioration in the mechanical signals, and also in these intermediate term, these are also starting to become quite questionable as to how much longer they'll hold up as bullish if we don't get some improvement in the price action. Position sizing opinions remain the same as yesterday, 50% on both models. We did have further deterioration in the intermediate term market posture, and indeed, as we anticipated yesterday, if they were to have any weakness yesterday, that these would fall below 80 and trigger new signals for weak bears, and that did happen. We now have all 4, including our benchmark S&P, now status weak bear with a weak bear sentiment line, so that also accentuates that weak bearish activity. Overall hedge warning status remains at level 1. Obviously, we could see changes with this depending on what happens with the FOMC, but at this point, it remains level 1. Option income strategies, VIX is not in the acceptable window to initiate new positions for novice traders, and of course, cover calls and put selling, borderline acceptable to initiate new positions for novice traders, and certainly today in front of the FOMC, if you're a novice trader, probably sitting on hands. In terms of specific warnings, We continue to see a sea of red coming in, market in decline, sharp increase warning once again, volatility ratio warning fired a couple sessions ago. We had a VIX spike a couple sessions ago. The VIX futures are up over 18. The daily squeeze is fired a couple sessions ago. We did have, with the distribution day count, a subtle change. This dropped to a 5 on the S&P. So this is just about borderline about to come off. Skew, of course, is up over 135, so that is an elevated warning, and the 10-day expected move up over 40 at this point, also in warning status. In terms of the trend base, we did have this deterioration going to weak bear, and the New York Stock Exchange new highs, new lows, 418 new lows put in yesterday, so that is warning status. In terms of the key intermarket risk aversion indicators, this continues to be all 5 on the risk off status, and none of them look close to rolling up at this point. Sentiment, pretty much of the sentiment that was extreme a few sessions ago has now scrubbed off with the recent weakness. You see very moderate on stocks. No, bonds and gold are at extreme sentiment levels, so watch for potential reversal patterns there. The fear and greed index, a perfect neutral 50, so very middle of the pack there. In terms of percent change, you see the intermediate term, short-term, long-term market postures by sector, and especially in that short to intermediate, pretty much a mess, pretty much a Christmas tree here with down, ups, and neutrals all playing roles. Now, let's break this down just a moment. Telecom has been improving of late, and notice that that's one of those defensive sectors. Also consumer staples, defensive sector. Utilities, defensive sector. So going into the FOMC, the 3 areas that contribute to the defensive sector kind of definition, those are the ones that are holding up as the most consistent. Transportation, all down. Financials, one of the morning authors mentioned financials, been taking a big hit. Retail's been getting clobbered. So kind of keep all that in mind. Percent change, you see telecom, utilities, consumer staples were the heroes yesterday. So all the rotation was apparently going towards the more defensive kinds of setups. So that should be enough for today, our abbreviated session. We got to get this published and out before the market closes. So I'm going to go and scroll through the closing sequence. If you see something of interest, go ahead and just hit the pause button, go to the hyperlink, and get your additional details. We do need to go to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note at the bottom here is a hyperlink that takes you to the full set of disclosures. We'll see you back here for the next session with the Falcon Global Market Preview. In the meantime, good trading for everyone.